Hello, everyone. This is Edwin Epperson, fund manager of the Blue Ocean Vertical Fund, president of Vertical Fund Management, a private money lender here in the state of Florida. I'm based out of Tampa, and we also do loans in Georgia as well as the podcast host of The Sophisticated Investor. Today, I am very excited. I'm actually I've anticipated doing this for quite some time now. This is going to be incredible. And so for some of those of you that I have discussed what I'm about to share today, you're going to be very pleased with what I'm going to be teaching, how you can implement this today into your own strategy, not only in your investments, but as well as the way that you build and protect your generational wealth for your family. So without further ado, we're going to get started. This will be done in a slideshow, so bear with me. I will be talking, of course, and I also want to caveat all of this. This technique, this method was actually taught to me by my mentor. I will give you a chance an opportunity at the end of this slide where you can join our private community that we have. Also, there are books written on this technique. I will list some of the books, or at least one of the books that I know of that I have read that covers this technique. I highly encourage you, if you want to dive more into it, you can go out, purchase the book, as well as we have our own community, the Sophisticated Investor community. If you want to become a part of the Sophisticated Investor community, come together with other like-minded investors such as yourself and learn how to implement this, actually share information, ideas, techniques, tips, strategies with the other investors and how to implement this right now in their own wealth building strategy. I highly encourage you to join our community. We'll be doing monthly webinars or monthly hosts, and you are more than welcome. All you have to do is subscribe to the podcast, The Sophisticated Investor, and get on our mailing list. And then that's all it takes. There is no fee. There is no annual purchase or anything like that. But you have the opportunity to network with other investors who want to change their mindset and the way that they look at investing instead of just blindly handing it to someone else who's investing it in, quite frankly, assets that maybe they don't even understand, much less that you understand. So without further ado, let's get started. Okay, so here we are. We're going to get started, and let me get this slideshow going. All right, so we're going to analyze two different types of people. I'm going to cover real briefly what 99.9% of all of us, how we view our cash flow and how we typically go about our monthly income. And then I'm going to show you the new way that's going to revolutionize the way that you guys understand cash flow and investment, how you understand finance. All right, so this is going to be really key, really critical. So most of us are like Sue. Sue, she gets her income into a checking account. She gets her income every month, deposit it into a checking account. Throughout the month, she pays bills from her checking account. She pays her living expenses throughout the month. And then whatever is left over, it either sits in the checking account or maybe she deposited it into a savings account or something like that, right? So I want to introduce to you the new way that you guys are going to start understanding your cash flow, your income, and what to do with it. So right now, I want to warn you, you're about to take a red pill. If you do not want to take the red pill, then you need to stop now, because I promise you, after this presentation, you will never, ever look at your income. You will never, ever look at finance the same way ever again. I can promise you that, okay? This is going to revolutionize the way that not only do you invest, but the way that you build, protect, and preserve your family's generational wealth. So what I'm going to teach you is how to be a Bob, not a Sue. So Bob does everything the exact same way as Sue, but the method by which he does it is completely different. So Bob gets his income. He deposits that income into an MSA account. Throughout the month, he pays his bills from the MSA. And then whatever is left over in the month, it sits there in the MSA. So exactly the same, like what they are doing is exactly the same. It is the methodology and their understanding of finance that has changed. So how can you be more like Bob and less like Sue? Well, I'm glad you asked. So most people's monthly income is deposited to a checking account, and it sits there idly for almost 3 weeks totally in total, about 3 weeks out of every month. Now, we understand you're paying bills. You don't get paid a big lump sum of money on the first and it sits there all the way until the 21st and then you pay all your bills, right? So I understand you've got bills throughout the month, but the majority of your capital just sits idly in a checking account and it sits there until you pay a bill or until you pay for a living expense. So it's just sitting there on average 3 weeks out of every month. So guess what? In a 40-year work life, the average hardworking person is missing out on 30 years worth. 30 years that money, it's not even being lazy. Lazy is at least they're working. They're not doing anything productive. This is dead money. You're taking this dead idle money and it's sitting there in a either a interest-free checking account or maybe it's earning a measly 0.001, whatever that return is. It's dismal and it's sitting there in a non-performing checking account. So what is the MSA? I mentioned that earlier. So the MSA is the tool, it is the account type, and then the methodology, the way that you're going to utilize this account is you're going to sweep your income through the account. So we'll explain all this later. But an MSA, a master sweep account, and that's what we're going to call it from now on, an MSA, is a method by which my investors are able to maximize the use of their idle capital, thus taking advantage of two key metrics, velocity of capital and the time use of capital. Now, what is an MSA? Now, if you go to your local bank and you ask them, I would like to open up an MSA or a master sweep account, they're going to laugh at you. They don't even know what it is. So what is an MSA? Well, simply put, an MSA is a line of credit that you open up at your local bank. All right. So you could use this strategy, the methodology of sweeping your income through these accounts. You could use it on a personal line of credit or on a home equity line of credit. Right. So the MSA, the account that we're talking about, is actually a line of credit. The way that you use this account, which most people, and if you have a HELOC or a personal line of credit, I would be willing to bet my next paycheck that you are not utilizing that line of credit the way that I'm going to teach you. So the methodology is to sweep your income through the line of credit. And we're going to dive into how powerful this is. All right. So here's some steps to open up an MSA. There's 4 steps. Well, technically there's 1 step and then there's 3 things that you want to be mindful of as you begin to utilize the MSA. Or again, a line of credit or HELOC. And again, from here on out, we're going to call the line of credit or the HELOC the MSA. So when I say MSA, just know that the type of account is a line of credit, and the way that we're going to use that account is the sweep methodology. So here's your steps. First, you're open up a line of credit or a HELOC at your local bank. That's the very first thing you got to do. Now, I say local, italicize and underline that because I really believe in your local relationships. If you go to a large national bank, they may give you some grief if your credit's not stellar and you don't have hundreds of thousands of dollars with them in some type of investment or checking account or savings account or whatever. So your local banks are going to be much more preferable to work with. Also, you're going to be able to possibly teach your banker something that they may not even know. My banker did not know about this until I started to share it with them. So there's a very high likelihood your banker knows about the line of credit, but they don't understand the methodology of sweeping your income through that line of credit. So here's some 3 key points that you want to keep in mind as you're looking at the MSA, right? So the MSA is preferred to have an MSA with check writing capabilities, but it is not required. All right. So if you can find an MSA that has check writing capabilities or debit card capabilities, or you can pay bills directly from the MSA, that is the type of account that you want. If you can't find that type of account, don't stress, don't worry. It's not that big of a deal. All right. So that's, again, why being a part of the sophisticated investor community is my investors who I'm teaching this methodology to, and we're implementing this methodology not only into our personal lives, but also our investments. We can strategize. You get tips, insight, how to utilize this, where to find the banks, what to do if your MSA does not have check writing capabilities. I just want to be clear. Don't get discouraged if you can't find an MSA that has check writing or debit card capabilities, okay? We can work with it. And if you're part of our community, we can show you how. All right, so all monthly income is deposited into the MSA as soon as you receive it. This is going to be the biggest hurdle for many of you because we have trained ourselves. When we get paid, we immediately deposit it into our checking account. We do that so that we can pay bills and we can live on. You will have to change the way that you do this. This is going to be this could be a stumbling block for some of you because it's going to disrupt for the first couple of months. It's going to disrupt the way that you've always done. The older you are, obviously, habits are hard to break. The older you are, the more you've been doing this, it's going to be a change in your mindset. Okay. I really am. You are taking the red pill right now. It is going down your throat. So it's about to get your stomach and dissolved and you will never be the same. So just understand to implement this methodology, you have to deposit your monthly income. And that includes that's not just your W-2 or your 1099 job. This is any income that you receive. Bonuses, tax refunds, interest from dividends or stocks or real estate or royalties or whatever penny comes into your account, it immediately gets deposited into the MSA, okay? Also, you will pay all of your bills from the MSA as close to the due date without incurring late fees or penalties. Okay, so we're not advocating, I would never advocate, and I never will advocate, do not pay your bills, nor will I say incur late fees. If your bill is due on the 7th, you need to make sure that your payment's in on the 7th, okay? And with today's technology, that's very easy to ensure that your bills are actually being paid on time. So with the MSA, you instead of paying your bills as soon as you get your invoice, so like many of you may have a cable bill. So you'll get your cable for your bill for your cable and your internet. And then, you will get that on the 12th of the month, but it's not due until the 15th of next month. And many of us have just been trained. As soon as I get the invoice, I go down, get behind my computer or get my checkbook out and I write the payment or I send the payment in via bill pay on your bank account. All we're saying is that you have to wait as close to the due date as possible, preferably on the due date before you send the money in. And I will explain why in a little bit. All right, so here we go. I'm going to cover real quick what we just covered, but I'm going to do a visual. So this helps the visuals help this stick into your mind. Traditional method. Okay, so nothing new about this. You get paid, you deposit your income, no matter what it is, into your checking account. Then throughout the month, out of that checking account, you pay your bills, your mortgages, and your living expenses. All right. Now, the new methodology is called the sweep the float method, right? So this is where we are sweeping our income, everything that we earn or everything that we get, we're sweeping it through the MSA. Okay. So it's exactly the same, guys. Nothing changes. You literally get paid. Your money that you get paid, instead of depositing into your checking account, you deposit into your MSA. And then everything else is exactly the same. Nothing changes. You pay your bills, your mortgage, and your living expenses out of the MSA. All right. So here's something that's going to be a aha for you all. Paying debt that costs you 10% is the same as earning 10% tax-free. Let me say that again. Paying debt that costs you 10% is the same as earning 10% tax-free. Now, let me take it one step further. Is earning the same as saving? I say no. And let me explain why. If you earn $1,000, guess what happens? That's right. If you save $1,000, what happens? Nothing. You don't get taxed on your savings. You get taxed on your earnings. That's why I say paying debt that is costing you 10% is the same as earning or saving money that you're not getting hit with taxes. All right. So paying debt that's costing you 10% is the same as saving 10%. It is the exact same. All right. So keep that in mind. That's going to start percolate. Let it sit there in your mind and marinate on that for a little bit. While you're doing that, I want to go ahead and start jumping into some examples. So first scenario, you get paid $5,000 at the beginning of the month. Now, this is not a trick question. I simply want to know what you would do. You can deposit that $5,000 into a bucket that's going to earn you 1%, or you could deposit that $5,000 into a bucket that's going to earn you 6%. Which would you do? Again, this is not a trick question. I'm hoping that you would put the money into the bucket that earns you 6%. But if you put the money into the bucket that earns you 1 1% on your $5,000, then you're going to obviously earn 1% on that 5,000. That 5,000 is sitting in that bucket available for your use. However, you will have to pay taxes on that 1%. Now, 5,000 is not that much, right? But you still have to pay taxes on it. Now, here's the MSA. Remember, paying off debt is the same as saving that money, or it's the same as earning that money tax-free. Right? So you've got a MSA that's got a $10,000 limit. Right now, you are utilizing $8,000. So that's an 80% utilization rate. You're utilizing $8,000. That's in debt, whatever that is. Maybe you went on vacation, which is what, by the way, a lot of people use their personal lines of credit or their HELOCs. They do not utilize it as an MSA. They utilize it as credit, and they use that credit to buy doodads. If you're a big Rich Dad, Poor Dad fan, then you'll know what a doodad is. They're out there paying for vacations, getting a new TV, getting a car, doing silly stuff with that money, right? So whatever the case is, they've got $8,000 in debt. Now, if you were to put that $5,000 towards that $8,000 in debt, it is the same as you saving 6% on $5,000. So instead of earning 1%, you've just earned 6%. Remember that little equation earlier, right? So paying off debt that's costing you a certain percentage is the same as earning that same percentage tax-free or saving that percentage. Okay? So now you still have the $10,000 MSA, and it's only got $3,000 in debt on it. All right? So let's take it to the next level. Here's scenario number 2. You get paid your $5,000 at the beginning of the month. Now, you've got 2 buckets. Now, unfortunately, a lot of people utilize, this is what they do with their money when it comes to debt. There's very wise, God-fearing people that are advising, get out of debt, which I am a big believer. I believe that you should not have consumer debt. Consumer debt will absolutely destroy you. Absolutely, hands down. But I believe personally that there is good debt. So what we're going to have, we got our $5,000, and you're going to have 2 options. You can either put that $5,000 into a checking account that's going to earn you 1%, or you've got a car loan debt. Now, this is what most people are doing when it comes to debt. You can pay down that $5,000 on that car loan. All right. So again, you got 1,000 or 1% bucket. You're going to earn 1% on your 5,000 if you put in your checking account. Or you got a $10,000 debt in your car loan. You're going to go ahead and pay that debt down by $5,000. Did you save that 6%? Yes. Is it the same as earning 6% tax-free? Yes. So what is the difference, Ed? Well, let's go to the next scenario, and I'll show you why that is probably not the wisest way to do it. Now, that being said, most of us, what we end up doing, right, is we'll put the $5,000 into our checking account. It sits there, not doing anything for us. And then at the end of the month, if we have extra money left over, we say, oh, okay, well, I've got about a few $100s. I'll pay down my car loan debt by a few $100s. And that's typically what happens, right? We know we can't put all that $5,000 down. And we know, but I'm going to walk you through why you don't do that. All right, so we're getting paid our $5,000. Scenario 3, $5,000 at the end of the month. Now, this time I'm going to give you 3 options, okay? 3 options. So you got 3 buckets this time. You've got your checking. You've actually already got $2,000 in your checking account. Good for you. All right. That means that's $2,000 from last month that you didn't utilize, and it's just sitting there. So you've got $2,000 in your checking account. You've also got an MSA that's got $10,000 limit, and you currently have $8,000 in debt. And you have a car loan right now that is $10,000, right? So what are you going to do with that money? Now, most of us, what we typically do is we put that money inside our checking account, and then we pay our debts down. All right, so let's take a look at what happens. Our balance from $2,000, we put our $5,000 in. Our balance now goes up to $7,000. Congratulations, you're now paying 1% on $7,000. All right, here's our debt. Now, we put our $5,000 down into the debt or into MSA. We're going to bump that MSA debt down to $3,000. So we're saving 6%, right? That's a good thing. That's saving 6% is the same as earning 6% tax-free. Or if you put the $5,000 towards your car loan, you go from a $10,000 debt down to $5,000, and you're also saving 6% on $5,000, right? I mean, either way, you're saving 6%. So what's the difference, Ed? Well, this is the difference. So we all know about the taxes. I've been hammering that home. You're going to pay taxes on that. But it is liquid, but you're paying taxes on it. In the MSA, it's the same as saving and earning, and it's liquid. You still have the capability. Remember, you've got a $10,000 MSA limit. You went from 8,000 utilization down to 3,000. That's good. That means you still have 7,000 of utilization that you can still use. And you save 6%. If you put that $5,000 that you earned that month onto your car debt, it's not liquid. You cannot go back to the car dealership and say, oh, snap, I put this money down on my car. I forgot that I have to pay my rent. Forgot that I have to pay my electricity, water, internet and cable, my food for the so you obviously, we all know that putting your entire paycheck into a car debt is not wise because it's not liquid. So that's the key point. It's not liquid. When you pay down regular debt directly, it is not liquid. So here's the fourth scenario. Now we're starting to going to have some fun. This is going to be exciting. So again, you're getting paid your $5,000. All right. Now, the same scenario, but we're going to put a little twist on this. Okay. So you got three buckets. You got your checking account, $2,000 in there. Congratulations. You've got an MSA, but it doesn't have any debt on it at all. It's empty, or it's completely full. So again, the MSA, you have to sort of change the way that you're looking at it. It's not like a checking account where you put money into it and then you have access to it. You already have access to the money. If you're not utilizing it, then you have access to $10,000, or you've got your car debt. So what would you do in this scenario? Obviously, this is a recording. I can't hear what you're saying, but tell the screen what you would do with the money. We'll let you sit on that for just a few seconds. All right. So, of course, $2,000. You could put the $5,000 into the $2,000. Now you've got a $7,000 balance. You can pay your bills and stuff like that out of there, right? Now, how would you, if I'm driving home the point that having your money sit in a checking account is an inefficient use of your capital and that you should not be doing that. So hopefully I'm driving that point home. But somehow we've got this conundrum. We've got an MSA, there's no debt on it. We've been paying down the debt, but there's no debt on it. We can't put the $5,000 into the MSA with no debt. That's not how it works. You have to have utilization and then pay down that utilization. Hopefully those wheels are starting to turn. So this is what you should do. What if you took that $5,000? Actually, let's go more. Let's go $8,000. Let's take that $8,000 out of that car loan. Guys, I hope you're getting excited right here. You take $8,000 out of your car loan. You take that $8,000, you move it over to your MSA. So now your MSA went from $10,000 up to $8,000. And we're going to cover utilization rates. We're going to cover how that affects credit all at a later time. All right. I just want you to understand the concept. All right. So we've saved, get this, we have saved 6% on $8,000 because we just paid off that loan, or the car loan, by $8,000, not $5,000, $8,000. And then we're going to take that debt. We're going to take that $5,000. We're going to pay it down again on your MSA. Wait. Did you get that? Did you see how powerful that is? Guys, I hope that you just caught how powerful that is. You've now got an MSA that's utilizing 3%, but you've got $7,000 or 30%, $3,000 in utilization, but you've got $7,000 in liquidity. Okay, you've got $7,000 in liquidity. You saved 6% on the $5,000 that you paid down. Also, your car loan, you went from 100% utilization down to 20%. What do you think is going to happen to your credit? Your credit is going to start shooting out the roof. Absolutely shooting out the roof. So I hope that the scales are starting to be removed from your eyes, right? This is good. This is so powerful. All right, so let's go to the next one. So here it is. So hopefully by now you can see what you should be utilizing your line of credit. Now you are always going to call a line of credit a what? An MSA. What are you going to call a line of credit? An MSA. It will never be called a line of credit or a HELOC ever again. You will never call it that. You will always call it an MSA. Why? Because this methodology is being revealed to you right now. I'm telling you guys, you have already eaten the red pill. It's already sitting in your stomach and it's starting to digest. There's no turning back. You can't stop. So you've got 3 debts. What are you going to do? What are you going to pay off? Now, obviously, if we look at what the annual MSA, the interest rate is, which we're going to cover in a minute, I'm getting excited. So obviously, you can look at that and like, wow, well, of course, there's only one that I'm going to use the MSA on. That's going to be my credit card and my student loans, right? Well, here we go. We're going to take money out of there. We're going to move it on over, and we're going to fill it up with the MSA. All right. So remember, understand this concept. The MSA is a better place to park your money, not a checking account. You will never use a checking account again. You are going to open up a line of credit, and that is exactly where your income will be parked. This allows you to leverage and utilize the velocity of capital and the time use of capital. Okay, so here we go. Now, I want to take number 5. I want to dive a little bit more into what does the banker look at? So how does a banker view all of this? So we've been looking at it through, Bob and Sue's eyes. So now let's look at it from a banker's eyes. So here's Mr. Banker. And Mr. Banker, well, you know what he's doing. He's having to pay Sue that 1%. So remember, money that sits in his checking account, right? Or wherever that money's sitting at the bank is having to pay you to keep your money sitting in their account. So yeah, he's paying $50 on his $5,000. All right. This is about to blow your all's mind. I'm telling you what. Now on that 6% utilization, so you've got a $10,000 line of credit, right? So I'm calling it purposefully the line of credit, right? So go back. So we're going back to the old way of thinking, right? So we're not looking at this through an MSA. We're looking at this as a line of credit. You are paying 6% on your $8,000 in line of credit. Now, 6% on $8,000 is how much? $480. Guys, gross, the banker is making $480 and he's paying out $50. Net, he's bringing home $430. All right. So if you take this and even it out across the board, the banker is more than happy to pay you 1%. And what's really disappointing is probably 99% of you and myself, we're not getting paid 1% on our checking account. So they're even making more money on us. All right. So now let's look at this through the eyes of the MSA, right? Now, you're not going to be putting that money in your checking account, right? It's never going in checking account again. It's going to sit inside your MSA. That's where your money floats. That's where it gets swept through. So let's take a look at this through the eyes of the banker, right? Ooh, big relief. He doesn't have to pay that measly 1% on that checking account. However, he is still making money. But dadgummit, he's only making 6% on $3,000 instead of $8,000 because you started to utilize your MSA properly. So what does it look like gross? Well, he's still grossing $180 a year, and he's paying out $0 a year. So what is his net? $180. Guys, $180 is much less to the banker than the traditional way of. Why do you think the banks have never taught you this? Why do you think that it's never even been discussed about in school or any type of educational institution? Because they do not want you to understand the way that they are utilizing your money. And we can break this down into all different aspects. I mean, okay, so they're paying you 1%, or let's look at CDs or anything else, right? So hey, I'm happy. I'm earning, 3.25% on my 5-year CD. I'm earning, 5% on my money market account. That's fine. The very same bank that you've got that out, they've given you a credit card. They're charging you 11% on that credit card. By the way, they've also got you on a mortgage, so they're earning money on your mortgage. It's incredible, guys. So what is the point of all this? So I want to break it down. There are 2 ways that we're going to now dive into how does the MSA work. Okay, so we're going to start unpacking this. The MSA is the bite. How do you eat an elephant? 1 bite at a time. So the MSA is the bite. That's what you're taking out of the elephant. The elephant is the debt. Now, right now, I've got a piece of property, right? So in the past, we've just been, using small debt. I want to start diving into the true power of utilizing your MSA the proper way. Okay. So the elephant represents any debt. Now that could be a large debt. That could be small debt. It does not matter. all just in your mind. The elephant is the debt. The MSA is the bite that you're going to take out of that elephant. All right, so here we go. MSA. So there's two calculations that you need to understand, which makes the MSA so powerful and why taking a bite out of debt with your MSA is exponentially compounding awesomeness compared to a checking account. So your daily interest rate. MSAs are not like a mortgage or any type of fixed credit, like a car loan or mortgage or anything like that. It's much more like a credit card, right? So it is taking the interest rate and it's breaking it down into a daily rate. So your daily interest rate, very important, very key. And that is how you get that number. Write this down. Annual interest rate divided by 365. So in the past example, 6%. You take 6% and you divide it by 365, you're going to get your daily interest rate. 12%. What's your daily interest rate? The same thing. Take 12%, divide it by 365. The other calculation that you want to know is your daily interest charge. That is your daily interest rate. So whatever you just came up above times the amount owed. So let's take a look at these. Let's break these down. Excuse me. So let's say your annual interest rate is 6.25. So you're going to take 6.25 divided by 365. What is your daily interest rate? I'll give you a few seconds. It's going to be a long one. This is the number that you should have come up with. All right. So you can either do 6.25 times 365, or you could do 0.0625 divided, excuse me, I'm sorry, 6.25 divided by 365, or you could do 0.0625 times 365. Both of them will give you that number. All right. Now, let's find our daily interest charge, okay? So we're going to take our daily interest rate, which we just discovered, and we're going to multiply that by our balance, which is $10,000. So what is the daily interest charge on $10,000? This is the number that you should have come up with. All right. So you're going to take that number, your daily interest rate, and you're going to multiply it by the amount owed. And then that gives you your daily interest charge on that amount. Okay. So let's take a look at this inside the normal line of credit use. Okay. So this is the way that most people normally use a line of credit. You've got that thing maxed out. It's got $10,000. You've got that thing leveraged out to the hilt. You went to Rome last summer with your girlfriend or your wife, and you planning a cruise. That's the only reason you paid out your line of credit, so that you could go out and go on another trip, or you could buy another doodad. All right. So this is the normal line of credit use. So you're getting charged $1.71 every day that thing is maxed out. Which, if you look at the grand scheme of things, I mean, wow, $51.30 to have use of $10,000. That's phenomenal. All right. Well, you've already eaten the red pill. Your mind should already be thinking of what is transpiring within an MSA. All right. So this is the traditional way, a line of credit, the way that 99.9% of all Americans, all people all over the world utilize a line of credit. This is how they normally do it. But this is now the way that you're going to use it. This is a sophisticated way to use your MSA. So remember, the first of the month, you've got that thing maxed out at $10,000. But now, I'm no longer going to let my money be dead to me. I'm not going to let it sit idly in a checking account doing absolutely nothing for me. Every single one of those dollars is an employee, and I'm going to work that employee to death. We're talking about dollar bills, guys. We're not talking about real employees, all right? So you could do that with your money. You can work that dollar till it's absolutely cutthroat dry. Doesn't matter, all right? So we're going to deposit our $5,000 into our MSA. Now, all you have to do is go back and run through that formula, which we just did, and you're going to find out that now, instead of $1.71 a day, now on the second day of the month after you deposited your income into the account, it dropped to 86 cents. And we're going to say, just for simplicity's sake, that you're going to leave that, you're going to let that money just sit there till the 26th, and then on the 27th, let's say all of your bills are due. All right? So all of your bills are due. So does it make sense? So we've got like 22, 23 days that were sitting there. It's just sitting at 5,000. Then for 5 days, 25 days, it's just sitting there. And then for 5 other days, it's maxed out. So what does that actually do to your cost? All right. So you deposited your 5,000 and then you paid your bills on the 26th. What does that look like? Well, for 5 days, you paid $1.71. So it's $8.55. And then I missed the calculation there. And then for the other remaining 25 days, you only paid 86 cents. The calculation, evidently, it's not there. But that's what your new total is $30.05 instead of $51.50. All right, so what does this actually look like? So that was a hypothetical situation that, quite frankly, was unrealistic, right? That would never happen. So what was actually happening? Well, let's take a look at this. So on the second, you deposited your $5,000 in your MSA, and then you paid a bill. You paid your mortgage payment. Then a few days later, you paid groceries, and then you paid your cell phone bill, and then you paid your aunt some money. Later on in the month, the 21st, maybe you went to the movies. You paid your electricity and water. And then at the end of the month, you paid your sewage and your trash pickup. So you're back up to 10,000, right? So this is typically what it looks like with a one payment system. Now, some of you, probably many of you, get paid twice a month. So you get a payment on the 1st and maybe the payment on the 15th. So again, that will drastically change because again, you're able to put another lump sum down inside that MSA. So what is the average daily amount lower? So, I mean, we can go in and do the calculations. And if you want to, which I would highly encourage you to take some time, if you enjoy numbers, some of you may not enjoy numbers and that's okay. But if you enjoy numbers, go through and see what the actual daily amount would be. But overall, is the average daily amount lower by utilizing it this way, or is it higher? Of course, it's going to be lower. And therefore, because it's lower, is the interest that we pay lower? Yes. And remember, saving is earning tax-free. When you save the money that you would pay interest on, it is the same as earning that money tax-free. So I want you to remember this. The lower the daily interest means the lower the effective interest rate. Very important. Effective interest rate can be vastly different than the actual interest rate. So here's interest rate, or the interest rate as you understand it, compared to effective interest rate. So we're about to roll back the curtains further. So $51.30 per month is based on a normal line of credit, and utilizing that same line of credit, but utilizing it with the MSA, you're only paying $30.05 in interest. Well, what does that actually equate to when it comes to the actual interest? Because remember, we're talking a 6% line of credit. So here's what we call effective interest rate. On the utilizing a line of credit the normal way, your effective interest rate, or the normal way that we've described here, is the same as your interest rate, because you're going to take your $51.30, whatever you're being charged every month, you're going to multiply that by 12, and then you're going to divide it by 10%, and that's how you get your interest rate. But remember, we are using the line of credit the MSA way. We're being sophisticated with the use of our finances. So the effective interest rate utilizing an MSA, so we take the $30.05, I said 50 cents, $30.05, and we're going to multiply that by 12, and we're going to divide it by 10, and that gives you a 3.28 interest rate. What? How is that? I literally almost cut my interest rate in half simply by utilizing it this way. How is that possible? Guys, think about what just happened. So let's take it back to that one scenario where you had your car loan at $10,000, you had an empty MSA, and then you were trying to figure out how to do. Remember, we were all saying this is all based on, the 6%, and that 6% was staying equal throughout the entire month, right? Well, now you've saved 6% on that 5,000, right? Or on the 5,000 or the 8,000 in the car loan that you moved over. You then paid down that 8,000 to 3,000 when you deposited the money in the MSA. But now that MSA, you saved that 6% because you moved it over. And now the MSA is not costing you 6%. it's costing you a lot less because of the way that you're utilizing your income, the way that you're sweeping your income through that account. All right, so let's dive into what this actually looks like on a mortgage and why this is so powerful on a mortgage, right? So I'm about to show you some calculations and some tools I have. One of these I can freely give you. You can go online and find it. It's a standard mortgage calculator. The other is a special calculator that is only available for the members of our community. And I will give you an opportunity to be interested in that community that my mentor owns. It's his community. It's not mine. Again, I did not figure this out. This was something that was taught to me, but I firmly believe in the power. And this is really one of those key tools that we utilize in the Sophisticated Investor and teach our investors how to utilize this tool to help them build, grow, and protect their family's generational wealth. So I'm going to show you two calculators. If you send me an email, I'll gladly give it to you. That's just a standard mortgage amortization schedule. The other is an amortization schedule with the ability to calculate utilizing your MSA, which is really powerful. And that I can't give to you, but I can definitely put you in contact with my mentor, George. So here we go. We've got an elephant, which is 2,000. That's a big elephant. Now, some of you have a much bigger elephant. Some of you have a much smaller elephant. Doesn't matter. The elephant is the debt, right? So some of you, many of you probably have been invested in real estate, you've owned real estate, or you currently own real estate. And you know that when you start paying down that elephant, when you start taking a bite out of that elephant, the very first payments are typically, much of it is going to interest and very little is going to principal. So the higher the loan amount, the higher of that goes to interest, right? Excuse me. So most of that goes to interest. Now, when the loan amount is lower, right? So let's say the loan amount is cut in half. The loan amount is lower. Now your less of your monthly payment is going to interest and more of your payment is actually going to principal. All right. So remember that the higher the loan amount, the higher the interest payment. The lower the loan amount, the lower the interest payment. But if you remembered, in both scenarios, the payment does not change. That's really, 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 really important. The payment doesn't change. It's called a fixed, or it's called an amortized loan, right? It works on both homes and on cars, right? So your car payment and your house payment, doesn't matter if you make an extra interest payment at all, it's going to be the same. It will never change until you pay the thing off, right? However, it's just the amount of that payment, what is going where. All right. So here we go. Here's the MSA calculator. This is the one I told you I'm not going to be able to share with you. I can show you what we've done. And then, of course, I can give you an amortization schedule where you can actually type in, you can play with it as far as your own mortgage is concerned and things like that. But this is a special calculator. And again, I can put you in contact with my mentor and you can get access not only to this calculator, but tons of other calculators and really tons of other incredible information. It's just really powerful. So right here, if you're looking at the screen, we've got a loan payment. Here's our $200,000 loan payment. It's a 12 payments a year, 30-year loan at 6% interest rate. And there's our monthly payment of $1,199.10. So I want you to take a look at a few things. I'm going to move my mouse over here. So if you look, right here, loan balance, the second month, loan balance is $199,800. Congratulations, you paid $200 to principal. That means of that $1,199, only $200 went to principal. That's how much went to interest, right? Right there, $999. So a percentage of your principal was 16.69% of your principal went to, of your payment went to principal, and then 83.31% went to your interest. And then, of course, this is going to show you your equity buildup, total amount of interest paid, and total payments. Let's go to the next. So we're going to jump down all the way to year 30, right? Because it's 30 year, which is 360 months. So 360 months, your last payment is $1,193. Hey, took you 30 years to change that monthly payment. So your last payment is $6 less, $6.04 less. So right here, we can look at this. You can see that all of that, and I want you to take a look at this right here. Total interest paid, $231,676.38. This is your total payment. For that $200,000 house, over 30 years, you've paid $431,676.38, which hopefully, with taking in consideration the average appreciation for properties in the United States in 30 years, your home should be worth that much. Hopefully it should be worth. Well, we're going to hope. But just from a pure numbers perspective, you've paid $431,000 in 30 years on this $200,000 house. All right. So when does a typical mortgage payment start to be applied to principal more rather than interest? So when does a typical mortgage payment, more of that mortgage payment starts to be applied to principal rather than interest? Well, here we go. If you take that same calculator, you get an amortization schedule online, or you request one from me and I send it to you. You type that in at month 223 months later. That's approximately, I believe it's 18.5 years. Your interest payment. So this is your principal. This is your interest. So at month 222, your principal was $599 and your interest was $599. Exactly the same. At month 223, you are finally paying $1 more or $2 more than you were last month towards your principal. Excuse me, $3 towards your principal, and now you're starting to pay less on your interest. Guys, that wasn't half. It wasn't at year 15. Most people think that, hey, about halfway through. No, this is 3.5 years later. You're finally over that hump, and you start paying more on principal. If 18.5 years is going to take you to start paying more if all you're doing. Now, again, this is not taking into consideration additional payments, right? I might have just given it away. Yes, I did. So what happens if we start utilizing the MSA to pay down, to bite off that elephant? So let's say you've got an MSA. Now, again, nothing has changed. Let's say you go to your bank and you get an MSA. And in our community, the Sophisticated Investor, we give you some strategies in how much you should be getting an MSA for, like what should be your line of credit option, and then how to utilize that and everything else. So we cover that in our community. But let's just assume that you get a $14,000 line of credit, an MSA. You're going to transfer that up month 2. You're going to transfer $14,000. You're going to take a bite out of that elephant. So you're going to, $14,000 payment goes to the house. It's for principal only. That's what you're going to write on your check. It's for principal only. And then your MSA now has that $14,000. I want to show you right here. Look at this. Your principal payment, remember, in the previous example, by month 3, your principal payment was like $201 or $202 is how much of your monthly payment was going towards principal. Now you've got $271 going to principal and only $928. Now, at the beginning, that doesn't seem like a lot. It's like, that big whoop-de-doo, Ed. But remember, guys, and I'm going to show you how this works, but because you moved that $14,000, it's not like you just moved the $14,000 and now you're only going to pay the minimum on both the house and the line of credit. Remember, you're sweeping your income. So remember, on day 1, that $14,000 that you moved over, on day 2, when you deposit your bill or your paycheck from your company and any other income that you're generating, it goes from $14,000 maybe down to $9,000, maybe $8,000 or $7,000. And then you're going to pay your bills out of that line of credit. And then you're going to get paid again. I'm telling you, it's incredible. Now, on average, we'll say on average, and there's some calculations that we work with our investors to figure out, based on their monthly income, based on all of that, like getting them set up properly and how to utilize the MSA. But the next time that you'll be able to, let's assume when would be the next time? So on average, it's about 1.5 years, something like this. Well, I can't even say average because it's just going to be dependent upon each investor. I call you investors, even though you may not be investing, but people utilizing the MSA, it might be about another 1.5 months. So we're looking at month 17. Your MSA now has a zero balance in it. So you go ahead and take another bite, $14,000. Look at this. Look at that payment. It went from $289 to $362. Guys, if you went back, if you have that calculator, if you've got a mortgage loan or amortization schedule in front of you, you're doing this calculation, it would take you this payment right here should not have happened, like this much going to principal should not have happened until year, oh my goodness, it's like year 7 or 8. You would be seeing that. You're seeing that right now at year 1.5. So when would be the next time? So we're going to go year 3, $14,000, another hit. Look at that principal payment. It jumped back up to, this is year 3, guys. Year 3. I hope you're getting excited. All right, look at this. Look at this, year 5. Another $14,000. So how many these are 4 payments that you're using your sweep account with, your MSA. So 4 payments, and you're already at, this is right before year 5. You're already at $584. If you remember, I mean, you're literally right there. I mean, look at month 61. You're year 5 and 1 month into payment. Look at that. $599.45, $599.65. Guys, do you remember when, if you're just paying your monthly interest, when that payment schedule would have hit? That's right. It would have hit at 18 and a half years. You just hit it at 5. 18 and a half years, you just hit at 5. Now look at this. Look at when you pay this bad beast off. Now, we're going to assume, I want to caveat this. We're going to assume that after year 5, after that payment above, that was the last payment you used. You just said, you know what, this isn't working. I don't get it, even though you've saved tons of principal and interest. You just decided that's the last payment you're going to do. So you've only done 4 mass chunks out of your MSA. And typically, you're going to do a lot smaller chunks, but it's going to be more frequent, right? So you're going to come down to year 16. Look at year 16. You pay this off at 16, just shy of 17 years. You paid the loan off faster than you would have hit the crest in the previous method of paying it off. And look at that. Look at your interest payment. You've only paid $94,000 in interest. Guys, you saved over $110,000 in interest. Look at the total payments made. Only $295. I mean, that's just phenomenal. Absolutely phenomenal. You paid it off in less than 17 and a half years. Very exciting. So how does this work? Like what's actually happening within that MSA? Remember, every payment after each MSA, more and more is going to the principal. Remember that every monthly payment, once you take a bite out of that income, once you take a bite out of that elephant, every time you sweep money through the MSA, it's chewing with each sweep. It's chewing on that elephant. That's how you bite it. All right, so remember, take money out, you move it out of the debt, and you sit there and you chew on it with your MSA. All right, so let's take a look at what this is actually doing as far as your monthly payments, right? So here's exact same what we just looked at, right? So 16.60% of going towards principal of your monthly payment. Monthly payment is $1,199.10. You take a bite out of your debt and you're chewing on it within the MSA. Now, we're right here. Now we've got $180,000. So now at this point, 25.3% of our payments are going to principal. Look above. See that green? That's the amount that's going to principal. So now more of our monthly payment is starting to go towards principal, not interest. So we take another bite, right? So we freed up the MSA. We're going to take another bite out of that MSA, or we're going to take another bite out of the debt and chew on it within the MSA. And then this is what we're looking at. So every time we're taking $20,000 bites out of that elephant, you're chewing on that, and more every time you do that bite, you're taking a leap ahead in how much of your monthly payments are going towards principal. That's what makes this so powerful. So this is the elephant, right? So I've been showing you the elephant, what's happening to that elephant. So here we go. Again, I'm big on visuals, okay? So I want to drive this point home. So it's the same concept, right? Here we go. We're going to take a bite out of the mortgage. We're going to move it over to the MSA, and we're going to chew on that bad beast. Now, however many months, it doesn't have to be 1-2 months later. It doesn't have to be 3 years later. It can be whatever time frame. Whatever that time frame, that MSA is back down to 0. Remember, your mortgage has already had that big $20,000 bite out. We're going to take another bite, $20,000 more. We're going to move it over to the MSA, and then we're going to sit there and chew on it some more. And again, we're at 160. We're going to do the same thing. We're going to take another bite down, and we're going to move it over to the MSA. You can see that if you continue to do that, if you continue to do this and chew and bite and chew, bite and chew, remember in the previous example, I actually stopped after right around year 5, if you remember. If you were to play, if you actually get the calculator and you play this out all the way through, you're not going to pay that house off in less than 17 years, just under 17 years, you would actually have that property paid off. I believe the calculation is, and I don't have it in front of me, I believe it's right at like 12 years is when you're going to have it paid off. And we can go into why this is so much more powerful than doing those bi-weekly payments or doing those find an extra payment every year to pay down your mortgage, like an extra mortgage payment. You find that, just find it somewhere and then pay it down. And there you go. You've got your house paid off in like 13 years or something like that. Well, you're having to change your living standard. You're actually having to go out and find an additional $1,199. And by the way, when you earn that extra $1,199, you're actually getting taxed on that extra money that you tried to earn so that you could pay down your mortgage faster. It doesn't make any sense. So here we go. Here's a comparison. Year 1, month 2, utilizing the MSA and then not utilizing the MSA. Mortgage payments are the same. Applied to the principal. Remember, because we made that big payment in month 2. So this is using that scenario on the MSA calculator earlier. Using that scenario, we made that big payment. Now $300,000 is going to our principal, and not using the MSA, you're still paying $200. Now, let's say the cost of the MSA is $60. Now, if you remember, that cost was a lot less than that, but we're going to assume it's $60 just for this. So if it costs you $60, then you have to back that out of your principal payment, right? So every month you're paying your $300 is going to principal, but it's costing you $60 to utilize the MSA. So your total principal pay down is not really $300; it's more close to $240. But is that more than the $200? Well, yeah. Okay, wow, Ed, I've saved. I paid down an extra $40. Big whoop-de-doo. Well, let's continue to play this out. Let's go to year 4. Now that's a big change. And again, we're not doing anything different. I'm not having you go out and find an extra mortgage payment every year that you're going to be taxed on as well. This has nothing to do with your lifestyle. You continue to live your life the same way that you've always lived it. Matter of fact, you have more freedom using the MSA. You have much more freedom, and we can dive into that later. But here we go. So year 4, month 2, your monthly payment, $592 out of that $1,199, $592 is going to principal using the MSA. Only $253 is going to principal not using the MSA. MSA is costing you $60. That's fine. What is your total principal pay down per month at this point in year 4? Well, $532 towards principal using the MSA, $253 not using the MSA. What about year 8? Well, there we go. Look at that. $965 towards principal. $965. And by year 8, month 2, not using the MSA, you're only at $321. Can you see the compounding effect of this? And look at that. Your total principal pay down is $905. Guys, $965, that was like close to year 27. If you just know MSA, that you're paying in year 8, month 2, using the MSA, you're paying the same amount towards principal that you would be paying in year 27, not using the MSA. All right. I hope that this has been eye-opening. I hope it's been revolutionary for you. I know that you've probably got a lot of questions. And more than anything else, I love to discuss this with people, help them understand it, because it is a shift in their mindset. You have to really work to understand what you're doing with this and how to make it happen. But I want to be able to help you. So this is how you can reach out to me. Please follow us, sign up for our newsletter. Not only will you get tips and insight on how to utilize the MSA, but a ton of other incredible, important information as far as investing, how to think like the bank, what we're doing within our community, and more importantly, we get to stay in touch. And so we've got a YouTube channel. You can watch our podcast. You can watch these episodes like this. You follow us on Facebook, join our Facebook group, or follow our Facebook page. And then if you're involved in these sophisticated investors, you'll get an invite to our Facebook group, where that's really where the networking happens, right? The sharing of information and strategies. And then, of course, you can always reach out to me on LinkedIn. That's where my primary social platform is. And then, of course, there's our website. So I look forward to seeing each of you in the very near future. And there we go. That's it. So I'm so very excited. Thank you for watching the video. I know it's been a little long. There's a lot of good information, and believe me, there's a lot of other techniques and understanding and wrapping your mind about how this works. It's a hurdle, right? It takes some effort. So what I wanted to do, as I promised, I would let you guys know how to get in touch with and join the private community. So the Sophisticated Investor is my community here in Tampa Bay. You can be a part of the community no matter where you're at in the United States and the world even. Again, we do monthly conference calls and webinars where we get together and talk. So you're more than welcome to join us on those. Please subscribe to our newsletter. You can go to our website, which was just put on at the bottom of the screen, as well as at the end of the presentation. Go to our website, and when you go to the website, it'll pop up. You can subscribe. Stay in the know for our newsletter, and that's another great way to get update information, stay on top of the podcast and other things. So the other thing I wanted to do is give you an opportunity to join our private community. So this is it's an invite only. You have to reach out to me via email, send me a request, and I'll send you a link. You can go listen to my mentor, and you decide if that's a community. Now that community does cost. There's a discount if you go through me. You don't have to at all. You can go on the internet and find them, but you're going to be very pleased. And this is what George calls a foundational building block. So this is one block out of many. You're going to be exposed to some of the most incredible financing mindsets. And be able to network with people that are just so. I mean, we're not talking a elbow party with business cards type networking. I mean, you're networking and you're rubbing shoulders with some very sophisticated and smart individuals. And I created this sophisticated community here locally so that the individuals locally can come together and we can be together. So if you're interested in joining that community, please reach out via email. You can send me an email below my email for the Sophisticated Investor, edwin@tsi.investments, and I'll respond as soon as possible. Thank you so much. I hope that this has been revolutionary. And by the way, you do not have to join the Sophisticated Investor community, nor do you have to join George's community. You can literally go out and do this yourself. There's no need. This is not secret hidden knowledge that you only can get if you pay for it. You literally have the knowledge right now. I've explained to you exactly what the MSA is, what it is not, how to utilize it, what makes it so powerful, and why it's working. How is it working within the MSA and concerning your debt? So hope that this has been fantastic. I look forward to talking with you. Give me a call, shoot me an email. I'd love to put our heads together and think of my investors and the investors that I'm teaching and training and coaching that invest with me. They and I have some really cool projects and things that we're wanting to do in the future utilizing this concept. If you don't understand this, it's going to be very hard, at least for my investors, to come on board and work with us in the future because this concept is powerful. Okay, so let me give you a taste. So this is utilizing you having your own MSA for your own benefit. Now, what if you were to go in with a group of other people that understood this concept? Right? So get this. You go in with the group of other people that have an MSA, they understand the concept of the MSA, and they have the discipline to utilize an MSA. You take a group of those 4, 5, 6 people. Now you go out and you buy an investment property together. That small group of people could own several free and clear properties. I think the way that we worked it out, if it was, calculated, everybody was taking equal chunks of the MS or equal chunks of the debt out. I mean, you could have 3 almost $1 million beachfront, maybe properties up in the Gatlinburg, up in the hills of, Smoky Mountains out in Colorado, Texas, the wine country out in California, no matter where, 3 free and clear properties between that group. And that's just 3. Every time you get another property, all the income from those properties are going to the MSA. I mean, it's just unbelievable. Guys, I cannot tell you, unbelievable. So I hope that this has been revolutionary for you. I hope that this has peeled back the layers of the curtains that the banks have put in over your eyes. I mean, these are tools that the banks are using right now that the average American doesn't even understand. So I hope that you use this. Please give me a call, shoot me an email. Let's get together. More than happy to grab a lunch, more than happy to do a video conference call and discuss with you some of the cool things that you're able to do with this and help you answer any questions that you have. So this is Edwin Epperson with The Sophisticated Investor, fund manager of the Blue Ocean Vertical Fund and president of Vertical Fund Management. Thank you very much. God bless. God bless. God bless, and make it a great rest of your week.